It is 8:18 a.m. Pacific Daylight Time. It is the 20th day of July, 2026, and this is episode 1355 of Bitcoin. And Saylor didn't buy Bitcoin again, but he didn't sell it either. That's going to be our lead story today, but Saylor won't be finished after that because he's got a little bit of an issue with BIP 110. Apparently, he's got 110 issues with BIP 110. You know, it's uninspiring to see somebody like Michael Saylor, who is so knee-deep in numerology, yet still can't be creative with it. This is the guy that makes statements like, Bitcoin's going to have a 21% return year over year from here on out. Why 21? Because 21 million. Yeah, he's got 110 problems with BIP 110. Why? Because it's 110. Honestly, this is a man that needs some imagination beyond creating derivative products that he can sell you supposedly to buy Bitcoin, but hey, it is what it is. Then we're going to move over to Europe, where the ECB is continuously freaking out about stablecoin and the fact that it's going to drain bank deposits. Two things about that. First of all, they're right. It will. And second of all, there's nothing you can do about it. Capital B is yet another Bitcoin treasury strategy company. They're announcing a stock split. And it's, we'll get into it. Kimmy and Alibaba AI releases, they shook Bitcoin, but now Moonshot is about to make an IPO. Yeah, we'll see what that's going to look like. And speaking of AI, we can't really not talk about AI without talking about data centers. And in this case, we're going to talk about data centers in the form of absconding with people's private property. This is not good. I don't like this because it is, and I know people throw this word around a lot. And generally speaking, it's blue-haired socialists and communists and stuff like that. But there is a time when the word fascism applies, and it's definitely going to apply to some of this stealing of private property. Vitalik Buterin is back in the news. I know I probably shouldn't talk about a shitcoiner, but there's something in here that I want to get off my chest. And then Allbridge gets hacked. DeFi is not done with the stupid, apparently. So let's do the Michael Saylor's argument against BIP 110. Let's get this one out of the way first, okay? So from decrypt.co, Stephen Graves is writing, Strategies Michael Saylor makes 110-point case against Bitcoin's BIP 110. Michael Saylor has escalated his opposition to a contentious Bitcoin proposal, publishing a sweeping 110-point essay over the weekend arguing that BIP 110 would cause more harm than the problem it targets. And of course, if you don't know what BIP 110 is, it is a proposed soft fork meant to curb non-financial data on the Bitcoin network. Titled 110 Reasons BIP 110 is a Bad Idea, the strategy executive chairman billed the text as a case for neutral rules, hard consensus, open markets, and permissionless innovation. Saylor said he shares supporters' goals, keeping validation cheap, payments affordable, and Bitcoin focused on sound money, but rejects their remedy. BIP 110 would, for around 1 year, tighten Bitcoin's consensus rules to limit the techniques used to embed arbitrary data, targeting the inscriptions and ordinals that have crowded block space and pushed up fees since 2023. Now, I got to pause right there. It pushed up fees for a little while, but guys, I'm looking at like 2 sat per VByte fees right now because nobody gives a shit about ordinals and inscriptions. So the way that sentence reads, it reads like fees are still a problem because of ordinals and inscriptions. They aren't. They just aren't. It's a fad. It's all bullshit. So I got a problem with some of these authors that make it sound one way when reality doesn't look like that at all. Continuing. Supporters, including developer Luke Dasher and the Bitcoin Knots camp, cast it as a way to fight spam, while critics say it would reject valid transactions and could split the network. Saylor's essay builds on his earlier argument that the danger lies in the precedent that BIP 110 would establish. Bitcoin cannot read intent, he wrote. The network can't tell whether bytes represents an image, a proof, a contract, or a future application. So restricting the forms used to store data also blocks legitimate uses. Spam is not a consensus primitive, he argued, and disapproval of a use is not invalidity. Changing consensus to police one contested use, he warned, creates a template others could reuse with privacy tools, novel custodial or custody, stablecoin settlements, or token systems potentially facing similar arguments. That, he wrote, is not a prediction but a governance risk. The restrictions would lapse after about a year, but the precedent does not. He brands BIP 110 as a Bitcoin iatrogenic proposal. Iatrogenic proposal? Iatrogenic, I think is how you pronounce it. Iatrogenic proposal. One where the treatment itself does the damage. Saylor also objects to the activation design, which lowers the miner signaling threshold to 55% from the 95% used in earlier soft forks and drops the usual option to let a proposal quietly expire. Signaling has been running below 1%, far short of that 55% bar, according to the proposal's monitoring dashboard. And Saylor cautioned that mismatched enforcement can divide the network. Saylor cast the dispute as a fight over Bitcoin's character. Quote, Bitcoin's strength is not that everyone agrees on every use, he wrote, arguing that it lies in the fact that disagreement is contained by neutral rules and hard consensus. He concludes that, quote, Bitcoin does not need guardians of purity, it needs guardians of neutrality. The strategy chairman's stance aligns him with Blockstream CEO Adam Back, CASA's Jameson Lopp, and Bitcoin advocate Samson Moe, who have also pushed back on BIP 110 against Luke Dasher in the Knots camp. BIP 110's mandatory signaling window opens in August, with activation targeted around September the 1st. The manifesto lands as Saylor's Bitcoin treasury firm pivots from its never sell stance to active capital management, pausing Bitcoin purchases as it builds up its cash reserve to $3 billion in order to fulfill stock dividend payments and debt interest obligations. And then they go on to other things they get out of the whole BIP 110, and it's unnecessary in only a couple more sentences. So there's something here, back up here, that caught my eye that I want to go back over. Let me reread this one part. Changing consensus to police one contested use creates a template others could reuse with privacy tools, novel custody, stablecoin settlement, or token systems potentially facing similar arguments. Methinks that Michael Saylor may have a future dog in this hunt. What do I mean? I'm not sure that Mike really cares about privacy tools, but novel custody, stablecoin settlement and token systems. That, I think, is what he's looking at. I think that Mike doesn't like BIP 110, not for the reasons that a lot of us don't like BIP 110, as much as he was probably going to want to do something like tokenize his derivatives and preferred stock and all the stuff that he generates. He's probably going to want to get into some kind of stablecoin settlement business. He's probably going to want to be able to offer some kind of novel custodian products to Bitcoiners, and he doesn't want that threatened. Now, this is just a gut feeling, but when he mentions these things by name, it makes me think that perhaps he doesn't want BIP 110 because it could cause a problem for him later on down the line if somebody doesn't like tokenized STRC, his preferred perpetual whatever he's calling it, tokenized on Bitcoin's blockchain. So you look for the incentives, and Mike's incentive here, I don't think is all that. Well, I hate to say the word, but I'm lacking another one. It's not all that pure. And I know, oh my God, another purity test. That's kind of not what I'm getting at, but I'm not going to fault you for thinking that way because, fuck, it is what it is. I'm just saying there's incentives here for Mike that make me wonder why he's coming down on the side of anti-BIP 110. Now, just to be clear, I myself am not a fan of BIP 110 to the point that I've had to mute on X those words. I don't really have to mute those words, BIP 110 or BIP -110 on Nostr, because over on Nostr, we're not really arguing about it. But when I get over to X to go look at stuff, my feed has just been inundated with this stupid ass argument. And honestly, the sniping from both sides has really worn thin for me. So when I muted BIP 110, it was to mute both sides of the argument, because at this point I know where I stand. I feel like if I'm talking about incentives and Michael Saylor, what are the incentives of Luke Dash? Or Dasher or Luke Dash Jr. I don't really know what he calls himself at this point. This is a man that lost 300 Bitcoin when he rolled his own security. And this was 4 or 5 years ago, I think. And all of a sudden, now 4 years later, he wants pedophilia to not be on. That is his main argument, is pedophilia on the Bitcoin blockchain. There's maybe a couple of pictures that have been loaded into the op return on a couple of blocks, a couple of transactions. It's if you listen to Luke, it's like every day somebody is putting pedophilia on the Bitcoin blockchain. But honestly, there's also other really bad shit that could go on the blockchain too. Like the anarchist cookbook could be on the blockchain somewhere, embedded into several transactions. Who knows? Because it's last I heard, you can kind of get in trouble for trying to get that book. It teaches you how to build bombs and shit like that. There's all kinds of stuff that is just, could be, clearly classified as really heinous crap. Any of it could go on any of these things. The argument that it's just pedophilia that is the problem leads me to believe that Luke, like Mike, may have ulterior motives, or there's a different set of incentives instead of really wanting to get rid of just pedophilia, or somehow or another knowing from a very base technical situation that it really is only pedophilia that is being placed on the Bitcoin blockchain, which I don't buy it. I don't buy it, not one bit. And I also don't like the fact that he calls people that are against 110, well, you must like pedophilia and you're a liar, without any proof whatsoever. And I've already gone through the legal ramifications of what happens when you make statements in public that can be seen by, hundreds of, tens of thousands, hundreds of thousands, if not millions of people, without any proof that what you say about that person is true. It's called libel, and you can get sued for it. And why nobody has brought a lawsuit against Luke Dasher for calling them a pedophile in public on such a public forum like X or even Nostr, because he's called people on Nostr pedos and liars there as well without a shred of evidence. Why nobody has brought a lawsuit is beyond my reckoning, because it's like that can be done today. He hasn't called me a pedo because he doesn't know who I am anymore since I got banned from Twitter years ago. But he used to follow me, and I was following him, but now this is a completely different person. It's bizarre and weird, but we're not done with strategy yet. They sold $263.5 million of MSTR shares, skips a Bitcoin purchase, to top up their USD reserve to $3.2 billion. This is out of Bitcoin Magazine. The 8K filing says Strategy sold about $263 million worth of Strategy shares last week. The Bitcoin Treasury Company reported the sale of 2.7 million MSTR shares between July 13th and July 19th. Proceeds went toward a $225 million boost to the firm's US dollar reserve, which has now reached $3.225 billion as of July the 19th. Strategy bought no Bitcoin, nor did they sell any Bitcoin, and they repurchased no shares under its buyback program across that period, which is all we really need to know about what was contained in the 8K filing. So, as normal, Saylor last night dropped his little orange dot plot and said, said something. I can't remember what he actually wrote on the X post. And I had the gut feeling that he was just going to buy more shares. I was definitely hoping that he wasn't, or not buy more shares, sell more shares of Strategy. And I was hoping that he wasn't going to sell any Bitcoin. And, thankfully he hasn't. And I don't like the fact that I have to say, thankfully he hasn't sold Bitcoin, because it brings to the fore the 846,000 Bitcoin elephant in the room, which is Strategy and Michael Saylor himself. And the fact that if he sells a single Bitcoin today and reports it, you're going to see Bitcoin lose its price. Not all of it, but you'll see it actually go down. It will cause a red candle. And and we can't stop him from doing it. This is the other side of the sword, because, it's a double-edged sword. This is the other side of that sword where we say Bitcoin is for enemies. Yeah, it is. Anybody can buy it, and I can't do a damn thing about it, neither can you. But when you've got so much of it that if you sneeze the wrong way, you affect the price. I just don't like that. And some people will say, well, that's Bitcoin's fault. No, not really. It's the market's fault. Or rather, not the market. The market is amoral. It's the people that and their baggage and their psychologies that participate in the market, because they just don't understand Bitcoin. We are still really early. It's there was a lot of times where I thought people are starting to grok it, and then they just go, ooh, stablecoin. Because it's that easy to manipulate the majority of 8 billion human beings, which is probably the saddest part of that whole story. And they're being manipulated over in Europe. The European Central Bank warns that stablecoins may drain bank accounts. Jose Antonio Lanz from Decrypt talks about Piero Cipollone's latest statements, because this isn't like from like a couple of weeks ago when he was saying this. He's still saying this. These are new statements. The European banks are losing the payments war in installments. First came mobile apps, which took their fee and transaction data. Then digital payments and startups took even more control. Now the ECB is warning that stablecoins could take the thing that really hurts, all of their money or their deposits. Piero Cipollone, maybe it's Cipollone, I never can pronounce his name, an executive board member of the European Central Bank, delivered that message Friday at a banking conference in Rome and framed the digital euro as the structural answer. Quote, even traditional debit card payments are becoming less popular. In fact, mobile payments are on the rise, and they already exceed 1 in 10 point-of-sale transactions in Ireland, the Netherlands, and Finland. When their customers use mobile apps, banks typically pay higher fees than those associated with debit cards and often do not receive any information about the payment. So they lose both fees and data, he added. Quote, if the use of stablecoin increases in the future, banks will also lose retail deposits. Let me pause right there. When customers use mobile payments, banks pay higher fees and often do not receive any information about the payment. Why do you need information about the payment? Other than how much it costs, what information do you need? Hell, I'll even give you a time of day and the date. I think that banks should probably have, hey, he spent $4.62 out of his bank account on the 11th of June. Maybe not the time of day, because that starts to get a little granular. You can start, when does this guy spend the most money during the day? What can you do with that data? Hell, I don't know, but somebody probably does. But where I spent it, what I spent it on is nobody's business. Why is Cipollone so concerned that banks will lose data? He's basically telling you they're keeping tabs on you. They're just completely transparent about the data collection situation that really, I think a lot of people still just don't realize. You don't realize that a bank may be working with your health insurance company, or at least delivering like their customers' data to, like, I don't know, Blue Cross Blue Shield of Texas, let's say. And if I'm like buying a shit ton of alcohol, let's say that I'm a heavy drinker and I work for something like University of Texas as a state employee. Well, those purchases, that data can come back and bite me in the ass if, when that data is sold to Blue Cross Blue Shield, which I believe is the health insurance provider for UT, it certainly is for Texas Tech. Then they can cross-reference and say, hey, look, one of our employees is such a heavy drinker. His health is in danger. Maybe we should cut him from the health insurance plan. See, that's actually already been done. People that buy cigarettes have had this problem. People that buy beer every single day have had this problem. I mean, the banks don't need this shit. Let's continue. He was speaking to an Italian cooperative bank executive who has their own reason to be nervous. In fact, half of Italy's cooperative bank branches serve towns with fewer than 10,000 people, where the loss of payment data could hollow out the local lending business. Stablecoin adds a new layer to that problem. They're privately issued crypto tokens pegged 1-to-1 to a fiat currency, usually the dollar, and that lets users hold and move money entirely outside of the banking system. You can think of them as a digital dollar that you keep in an app rather than in a bank account. And even fintechs like PayPal, Stripe, and others rely on traditional banking systems one way or another. The global stablecoin market is about $300 billion. Cipollone is worried that the massification of stablecoin adoption may render cash deposits irrelevant. Mobile payments cost banks fees and data. Stablecoins could cost them the deposit base that they rely on to make loans. Deposits aren't just a number in a ledger, they're the raw material banks use to extend credit to businesses and home buyers. Fewer deposits means less lending, and for small cooperative banks with thin margins and local customer bases, that's an existential problem, not a spreadsheet problem. The ECB's proposed fix is, ironically, a digital euro, a government-issued electronic form of cash distributed through, not instead of, commercial banks. Under the current design, banks keep customers' accounts, earns interchange fees, and retains transaction data. The ECB has already named 36 payment providers, including Deutsche Bank, UniCredit, and Revolut, for a 12-month pilot starting in the second half of 2027. And we've already covered, we kind of covered that last week when Cipollone was up in arms at some other banking conference. But the message that the ECB is sending out is now, at this point, fully firmed up, and it is now a marketing strategy against stablecoin. And a couple things, they've already lost. They're not going to be able to do anything about this. And second of all, the way that they are framing it is that the loss of deposits is going to cause a situation where businesses and home buyers can't get loans. And that's bullshit. It is true that the traditional banking system, if they lose deposits, won't be able to make those loans. That is in fact the case. But new companies are coming up that will be using stablecoin, and they will figure out some way to have deposits, and they are going to make loans to businesses and home buyers, and they're going to make auto loans, and they're going to do everything that the old banks did, except they're not going to be owned by these banks unless these banks, the legacy banks, figure it out fast. And I think it's too late, and I'm surprised that they haven't already figured it out. They needed to get into this game rather than fight against this game, and they needed to do that starting about, 7 to 5 years ago. And they haven't. They've spent all of their time and all of their resources bitching, moaning, crying, and fighting instead of embracing this shit and making it their own. It's their own fault that there's going to be a sea change in who is in control of global banking. And global banking isn't going away anytime soon. Yes, I know. That's why we want Bitcoin. But people are people, and psychology is psychology. And you're fighting against 5,000 years of utter bullshit that has been ingrained into the human psyche as to how we're supposed to act and what kind of products we're supposed to use, and blah, and this and that, and blah, and this and that, and blah. It just goes on and on and on. So that's why all that really happens is that the old power brokers lose their power to new power brokers. And the new power brokers are going to be just as shitty as the old power brokers. And if you are somebody who wants to be one of the new power brokers, and hopefully you won't be a dick about it, go to sagebrushcs.com. Get your LLC. Incorporate your business. You can do all kinds of things at sagebrushcs.com. It's a Wyoming-based company that does this. In fact, they help founders form, maintain, and protect their companies with dependable registered agent services, clean filings, and same-day document delivery. We keep Wyoming simple. Flat pricing, fast communication, and compliance reminders that you can count on. From first filing to annual reports and beyond, we tailor support for your goals, LLCs, corporations, nonprofits, and international owners. We're not a law firm, but we know the process cold and coordinate smoothly with your attorney or CPA. In Wyoming, there's no state income tax. There's low annual fees. There's fast online filings. Wyoming's LLC laws are respected nationwide and preserve owner privacy. If you form your company in Wyoming, you can operate anywhere. Go to sagebrushcs.com. They are today's Circle P vendor. Circle P is open for business. It's where I bring plebs with goods and services just like you, to plebs just like you who want to buy said goods and services, but you will be buying into Bitcoin, because if you're not selling into Bitcoin, you're not in the Circle P. Sagebrush CS. That's Sagebrush Corporate Solutions, sagebrushcs.com, sagebrushcs.com. If you need to open a company, you need an LLC, you need corporate filings, Sagebrush CS, based in Wyoming, will help you out. All right, Capital B approves a 10-for-1 reverse stock split to broaden investor base. So the whining and the gnashing of teeth in the Bitcoin treasury company space has not abated. Johan Yoon, writing for Cointelegraph, Capital B, Europe's second largest Bitcoin treasury company, will consolidate its shares in a 10-for-1 reverse stock split aimed at broadening its institutional investor base. The reverse split will reduce the number of shares to about $30.1 million from $300. Sorry. Let me do that again. The reverse split will reduce the number of shares to about 30.1 million from 307 million shares. Each new share will replace 10 existing shares and carry a par value of about 90 cents US, up from 0.08 euros. Capital B said in a Monday statement. The Euronext Growth Paris listed company said the conversion will occur automatically on September the 8th without changing the aggregate value of investors' holdings. Capital B said the move is intended to support its institutional development and appeal to a wider pool of investors. Last month, shareholders approved up to 105 billion euros in financing capacity to support the company's Bitcoin acquisition strategy. Capital B holds 3,139 Bitcoin at the time of writing. Germany's Bitcoin Group SE holds the most among European companies, with 3,605 Bitcoin, according to Bitcoin Treasuries. So the last time that we heard about a reverse stock split, I believe, was Nakamoto, and it didn't help them. So the reasons given here in this piece for, they want to appeal to a wider investor base, is complete garbage. Bitcoin treasury companies, unless you're the big one of the big five, and I don't believe Capital B is one of the big five, you're having issues. You're having real problems with the price decline overall in Bitcoin from last October the 10th of 2025, to be specific. And people are fleeing. So Nakamoto, or Capital B, like Nakamoto, is doing a reverse stock split. It's not a good look. Let's just say that it's not a good look when you do a reverse stock split. In some cases it is, but not in these cases. Not in the cases these small Bitcoin treasury companies. They're doing it because they risk getting delisted. That's why Nakamoto did their reverse split. It wasn't to attract a wider investor base. It was so that they wouldn't get delisted. It was so they could retain any amount of investor base, not appeal to a different one or a bigger one or a newer one or a broader one. No, it has nothing to do with that. These things are trading at prices that are so low that they risk being delisted. Now, that's not said here about Capital B, but I guarantee you it's part of the thought process. Let's run the numbers. CNBC futures and commodities. Brent North Sea up, but only slightly, while West Texas Intermediate is down a quarter point to 82.32. So looks like people are like, we had a pretty big price hike in oil yesterday at market open, which is 3 p.m. my time. We saw a gap up. So it was like I think it went from like $79 to 84 on West Texas Intermediate, like right at 3:00 yesterday afternoon. Of course, because of the new hostilities between the United States, Israel, and Iran. It's not good. But right now, it looks like people are in a holding pattern again. They've already blown out all, melted the faces of all the shorts on oil yesterday. So it looks like people are waiting for any kind of new news. Natural gas is down 2.2%, $2.84 per thousand cubic feet. Gasoline down 0.6 to $3.37 a gallon. And Murban crude is down a third to 81.06 a barrel. Metals are mixed. Palladium is up 1.3%, but gold is down only slightly, though. Recaptured 4,000 to get to $4,018 an ounce. Platinum is down a half, but silver is up 1.68% to $57.27 an ounce, and copper is up 1.16. Ag is mixed as well. The biggest loser today is chocolate. It's a third of a point down to the downside. No, I take that back. Wheat is down 3/4 of a point. It's our biggest loser. Lumber is up 2% today, so it is our biggest winner. Live cattle up a point. Lean hogs up, but only slightly, 0.17% in the green. Feeder cattle up 1.5%. The S&P is up a quarter. NASDAQ is actually up 3/4 of a point today, so I guess there's some recovery in the chip sector. The Dow is down 0.26%, and the S&P Mini is down 0.14. And then there's Bitcoin, chilling at $65,480. It's a $1.31 trillion market cap, and we can get 16.3 ounces of our favorite shiny metal rock with our one Bitcoin, of which there are 20,058,844.89 of. Average fees per block are normal, 0.02 BTC taken in fees on a per block basis. It's about 45 blocks carrying 95,000 unconfirmed transactions waiting to clear at high priority rates of 5 sats per VByte. Low priorities will get you in at 2. Hash rate has risen 929 exahashes per second. That's the security of the Bitcoin network, and it makes me feel all nice and fluffy inside. Reminder, go to bitcoinandshow.com and show me some love. You can show love at bitcoinandshow.com, bitcoinandshow.com. I got a free tier, I got a $5 a month tier, and I got a $50 a year tier. Everybody gets the same stuff. If you believe I'm showing you or providing you value with this show, and you need to provide value in a fiat format, you can do it at bitcoinandshow.com. If you want to show love in Bitcoin, then do it through any Podcasting 2.0 app. You can throw me Boost. You can stream me Satoshis. You can do all kinds of neat stuff to get actual Bitcoin into my hot little hands. It works. It works really well. You can use any Podcasting 2.0 app, and you get a lot more stuff in those apps anyway. You get chapters, you get transcripts, you live shows. You get live shows. You can't do that with legacy podcasting apps. I use fountain.fm, so go to fountain.fm. You can get it for Android or iOS. Now, from Kimmy Burns Markets, which was Friday's episode of Bitcoin And, I got a row of sticks from INCP. 1,111 sat says, if you don't zap Dave, do you even bang? Jason High with 250 says, have some sats. Noster Gang with 101 sats says nothing, and that's the weather report. Welcome to part 2 of the news that you can use. Moonshot AI IPO push follows Kimi. Alibaba AI releases that shook Bitcoin. CoinDesk. Shara Malwa is writing this one. Moonshot AI, the makers of Kimi, is preparing to go public within 6 months, moving to tap capital markets just days after Kimi 3 model upended assumptions about how far behind China's AI sector really is. The company has distributed a shareholder resolution seeking its backers' approval for a Hong Kong listing. Monday, sorry, I screwed up. I saw a comma as a period. Let me do it again. The company has distributed a shareholder resolution seeking its backers' approval for a Hong Kong listing, Bloomberg reported Monday, a step that signals an IPO could come within 1.5 years. The company is also wrapping up a funding round that may value the 3-year-old startup at more than $30 billion, up from $20 billion it commanded in a Mushin-led round in May. The timing follows a sharp jump in the numbers driving the company's growth. Moonshot's annual recurring revenue, a gauge of forward sales, reached $300 million in June, up from $200 million in April. It temporarily paused new subscriptions for K3 over the weekend as demand outstripped its capacity, with daily sales said to be up at least 6-fold since the model launched last week. K3 forms the bedrock of why the listing looks different than it would have a month ago. The open weight model outscored every rival except Anthropic Claude Fable 5 and OpenAI's ChatGPT 5.6 on certain parameters, and topped a widely watched coding benchmark outright, triggering a semiconductor sell-off on Friday that dragged crypto down with it. Moonshot is not moving alone. China's Alibaba said on Sunday its Qwen 3.8 model is going open weight. A $2.4 trillion parameter system the company claims trails only Fable 5 among frontier models. A preview version, Qwen 3.8 Max, is already live across Alibaba's developer tools. Open weights lets anyone run a model without paying its maker, which pressures the pricing power of American providers that charge by the token. A parameter is one of the internal dials a model adjusts during training to get better at predicting text. Modern models have billions or trillions of them, and the count is the rough, imperfect shorthand the industry uses for raw size. Bitcoin is traded as a proxy for the AI capital cycle all month long, and its miners have rebuilt themselves into AI data center landlords whose leases depend on demand for compute holding up. The next read comes this week when Alphabet, Tesla, and Intel all report earnings that will show whether AI capital spending is still climbing and whether the miners betting on it keep their footing. Okay. So, aside from the fact that Bitcoin's price is somehow or another being linked to this whole AI thing, and I don't think it's being linked because a lot of the AI data centers are being built by the old Bitcoin miners. Although, I mean, that argument can be made. I just don't think that that's all of it. I think people feel a little bubblish about this whole AI thing. It does not mean that AI itself is a bubble in the exact same way that the internet bubble was not really about the internet itself. What do I mean? I just mean the internet is still here. That's how I'm talking to you. I bet your bottom dollar that 100% of you listening to this are using the internet to get it, to stream it, to listen to it, something like that. You're not going direct. I mean, even if you go directly to my podcast host, podhome.fm, and stream it directly from there, you're still using the internet. You know, so the internet bubble didn't destroy the internet itself was not the bubble. It was the financing around the internet. It was the greedy ass people that don't give a shit about whose lives financially and otherwise that they destroy to get what they want. They just used hey, it's the internet, man. The internet's going to make everybody rich. Give us a shit ton of money because we've got a company it's an internet company. It was literally just like that. That is literally some of the sales pitches that you would hear from people that were trying to build, get VC money to build internet companies. And most of them collapsed because various reasons. One of which, there was no payment structure for the internet. In the early internet, you might as well be reading a Sears catalog and using the order sheet at the back and using a pencil or pen to write in what you want, how many of them, and then you had to write them a check and put it in the mail and mail it to them. And yes, you had to do the same thing with early internet companies. It was just so happens that their catalog was on the internet, but you couldn't give them money through the internet, right? And that was one of the major problems with the internet back in the day. And it certainly did not help sustain the internet financing bubble. Well, we're here again. AI is not going away. It's extremely useful. It's got real utility. It's got real product market fit for the people that actually understand how to use AI effectively. And there is a difference, right? But the financing behind it, oh my God, it looks exactly like the internet bubble. And it's going to pop. And when it does, there will be hurrahs and hoorays in the street after people, before people figure out that their retirement accounts got, brutalized. But before that moment, they'll say, see, I told you. And guess what happens a week later, a month later, a year later, 5 years later? AI is still here. The AI bubble popping has nothing to do with the utility of artificial intelligence itself. However, that said, the Bitcoin miners that never gave up on Bitcoin mining and have just gone into and added to their revenue portfolio data center stuff and AI stuff, they're going to end up being the ones that don't feel the pain as much as the people that just got rid of all of their Bitcoin miners and went nothing but AI. Those guys are going to get fucking launched. And final word about this whole thing. When I was ranting on Friday about Galaxy and the deal between them and Texas Tech, I didn't realize that it was Galaxy Digital and that was, who's that Terra Luna guy? I can't remember his name off the top of my head. Billionaire dude, got a Terra Luna tattoo on his left arm. That's his outfit. So my alma mater is tied to a guy that was telling everybody to go buy Terra Luna for an entire year before the Terra Luna depeg happened and the FTX collapse happened right after that, which took down Alameda Research and BlockFi and a whole bunch of older Bitcoin or supposedly Bitcoin companies. They were more shitcoins than they were Bitcoin, but still, it was the whole crypto thing just collapsed, right? That was what, 2021, 2022, somewhere around there. Yeah, it's this guy. I wish I could, I don't wish I could remember his name. It just seems odd that I can't remember this guy's name because he's a billionaire. He's huge. And Galaxy Digital is one of the companies that did not trade all of their Bitcoin miners for AI. They're still mining Bitcoin. And they've got 3 campuses that they're building in West Texas, northwest, about 50 miles northwest of Lubbock, Texas, which is where Texas Tech University is. And if you didn't know, they signed a $75 million deal over 15 years to rename the Jones football stadium Galaxy Stadium. And I can't believe that my alma mater is in bed with one of the guys that was one of the main Terra Luna lunatics. I just can't stand it. Okay, speaking of AI power data centers, we got power companies that are involved in all this, as you well know. Well, this is from tomshardware.com. Power companies can seize private land to make way for new AI data center transmission lines, report says. Takeovers could be implemented using eminent domain law. when private citizens refuse to sell land. A report by The Conversation has claimed that power companies can seize private land to make way for new transmission lines needed to meet the surging electricity demand for data centers. According to the July 16th report by Aaron Waylat, assistant professor at law at the University of Dayton, power companies can use eminent domain, the legal authority that grants the government the power to take private property and convert it to public use in exchange for compensation to implement these takeovers. The AI boom has led to a surge in data center growth in the United States, with thousands already operational and several more planned or under construction. While the massive superclusters are necessary for the revolution the AI has brought about, there's growing opposition to their construction. In many instances, data centers draw the required electricity from the grid. As the industry enters the gigawatt era, utility companies are under pressure to increase supply to meet surging demand. This requires building new power infrastructure such as transmission lines, which often have to cross private land. And when that happens, the power companies try to buy the land, but should the owner refuse, the government can force a sale through eminent domain. The law grants the government the power to take private land regardless of the owner's consent, provided that the land is for public use and the owner receives just compensation. The government can also delegate the power to private entities or common carriers such as utility companies. It is this legal authority that puts power companies and enables them to implement takeovers. Oh, this bad sentence. According to the report, the law does not automatically grant infallible authority. The company must prove that the infrastructure will be for public use. Several states also reserve the right to interpret eminent domain laws according to their own constitutions. All right. Eminent domain, I understand why it was put into place long time ago, at least in the United States. Can't speak for anybody else, but in the United States, I can understand eminent domain under certain circumstances, like building a hospital, a public, not a private, but a public hospital. There's no other place to build it. We got to go to Farmer Joe. Farmer Joe, we need you we'll buy this land. Let us build a hospital. No, it's my land. You can go, fuck off. And then, okay. And it's not that I accept it. It's not that I rah it. It's just that I can understand it. Doesn't mean I agree with it, but I understand it. However, eminent domain has become out of control. It's, and I literally saw it in Lubbock, Texas itself, except it was at the city level, not the county level, not the federal level, not the state level, at the city level. The city forced some homeowners to sell their property to the city so they could run or expand, or I think they were widening a certain highway or something. I can't remember exactly what it was. But that highway was basically being somehow or another built to service a private housing development in what was then known at the time as North Overton. You might want to go look at it. And it was the McDougal family who was in power at the time. I think his name was Mike McDougal, was mayor. And all of a sudden, you got this huge housing development going up, and these streets and a highway needed to be built, so they declared a whole bunch of houses as eminent domain when those house owners refused to sell their property to the city. It's evil, because this is a private concern. It wasn't for public use. And yet they were still able to do it. And these homeowners got justly compensated, but they could have gotten more. It was a bad time in Lubbock when a bunch of this stuff in North Overton was being built. Arson, people that, all of a sudden there were people that wouldn't sell their houses, and all of a sudden, and there was 15 of these things, all of a sudden their houses magically burnt to the ground. And they kind of had to sell. because it wasn't just kind of got burned. I mean, burnt to ash. So whatever accelerant was being used, and there was an accelerant being used, was very volatile, burned very hot, and burned for a long time because it was able to ignite enough of the combustibles in these structures to burn them to the ground alongside city-wide eminent domain seizures. These are the kind of people that we walk around with, ladies and gentlemen. They're just dicks. We need to learn how to not be dicks to each other. Unless you want to be a dick to this guy. Well, no, actually, don't be a dick to Vitalik Buterin, even though he is the author of one of the greatest shitcoins ever to shitcoin. Ethereum co-founder Vitalik Buterin vibe codes anonymous Billboard demo with on-chain moderation on Aztec. The block Naga Avan Nameo is writing this one. Vitalik Buterin has released a working demo of an anonymous message board on Aztec, pairing fully private posting with an on-chain moderation layer. This is the important part. The Ethereum co-founder shared the project Sunday on Farcaster, calling it a vibe-coded toy version of the Anon Billboard with moderation concept that he outlined in a 2022 blog post. The code is public on GitHub under his V Buterin account. The billboard is built on Aztec. Users deposit ETH on Ethereum's base layer, post messages anonymously on layer 2, and later withdraw their ETH back to layer 1, according to the repository. Posts carry no sender addresses and public call data, and no link to the original deposit. Buterin also noted that Aztec had reached stage 2, the most decentralized tier on the layer 2 maturity scale, in a follow-up Farcast, or they call it a cast, otherwise known as the post on the Farcaster platform. The design attaches a, wait for it, sensor role set at deployment that can flag posts as immoral. Flag posts are hidden from the default feed and impose a time lock penalty on the poster's next message. A local LLM daemon watches the board, evaluates each post against an on-chain moderation policy, and flags anything that violates it per the documentation. The policy itself is stored on-chain and readable by the app, the CLI, and the daemon. Posting is rate limited through a cooldown that shrinks as the deposit grows, meaning 0.001 ETH buys 1 post per hour, while 0.01 ETH buys 10, according to the repo. Part of the system also carries formal verification. The security properties covering rate limits, censorship screening, privacy, and deposit safety are proven in Lean 4 across 70 theorems with 0 unproven gaps, according to documentation. The repository lists the work as early and incomplete, with open items including access control fixes and untested browser flows. Buterin said in his cast that the demo can already do very interesting, non-trivial stuff. And that's the end of the article. So, there's two things here. Vitalik Buterin is definitely not your friend. And it's not because he designed ETH. It's not because he's, an ETH head. It's not any of that. It's because he's using AI to flag shit public posts as immoral or not. So it's a completely censored platform. He started building and finished by vibe coding a censor platform. He didn't go for, hey, everybody needs to be able to say whatever they want. No. He built exactly the antithesis of that. This is a man that is not to be trusted. I'm just saying, man, this is not the way we wanted to go. But there's another thing here that let me reread this. The billboard is built on Aztec, and users deposit ETH on Ethereum's base layer. Then they post messages anonymously on layer 2 and later withdraw the ETH back to layer 1. I don't understand that. So I deposit ETH on layer 1, and then I post a message on layer 2, and then withdraw my ETH back to layer 1. So I guess that means that I what really happens maybe is that I deposit ETH on the base layer. I post a message and that costs me money. So like ETH, which I guess goes along for the ride into layer 2 because the postings are kind of done on a layer 2. So if the money comes along for the ride to pay for the posting, then I can get the money back later. But what happens if I get flagged as being immoral because I say Luke Dash Jr. doesn't like pedophiles? Because I'm sure that the AI agent will say, oh my God, he used the word pedophile, not allowed, flag the post as immoral. You see where this is going. All right. Do they take my money? I don't know. And I'm like, you're probably sitting there saying, well, you should have researched it more. Really? No. Because all we need to know is that Vitalik Buterin, who somehow or another billed himself as a Bitcoiner and then was not a Bitcoiner because he got pissed off at Bitcoin Core because they wouldn't let him do something, and he started ETH, and now his brain is wrapped around how do we censor shit? If you are still, for whatever reason, thinking Ethereum is the answer, it is not. Finally, up today, Allbridge pauses cross-chain bridge after a $1.65 million exploit. This is out of Cointelegraph. The company behind cross-chain stablecoin bridge, Allbridge Core, said it has paused the protocol as a precaution after a security incident that reportedly saw $1.6 million drained on Sunday. The incident affected Allbridge Core Solana deployment, with the attacker having already bridged the stolen funds from Solana to Ethereum before moving them into privacy pools. That's all we need to know. And except for one thing, I read this entire article, which I'm not going to read to you because it's not worth it, looking for one word and one word only, and that was DeFi, and it's nowhere in this. Why is that important to me? Well, because I know that Allbridge, especially the whole Allbridge Core stablecoin bridge, is exclusively used in DeFi. Yet DeFi has been hammered so hard that Cointelegraph cannot bring themselves to use the word DeFi one more time when it comes to yet another hack. And I think that that's disingenuous. So Allbridge is a DeFi chain. It is part of the DeFi ecosystem, and as such has been hacked for $1.65 million yesterday. If you are still toying around, monkeying around with this garbage, stop. Just buy Bitcoin, hold Bitcoin, and I'll see you on the other side. This has been Bitcoin and I'm your host, David Bennett. I hope you enjoyed today's episode and hope to see you again real soon. Have a great day.